My goal here is I'm going to try to explain to you what supply chain management is in kind of an interesting and exciting way. I'm just going to show you what people are doing in supply chain management to give you a feel for what this major entails. I will begin by saying job placement, starting salaries, all of that stuff is through the roof and has never been better. If you come to college and make a bunch of great decisions, you'll have jobs when you graduate, and chances are you'll have multiple job offers. You just have to make a bunch of great decisions. One of the most important decisions that you can make at the undergraduate level isn't necessarily where you go to college, but it's what you major in. And if what you major in has economic conditions where demand exceeds supply, you're well on your way to getting a great paying job when you graduate. So I try to give my students some general advice on if you want 5 job offers when you graduate for 50, 60, 70K a year, what are some of the decisions that you have to make? I will admit, what I'm noticing is the more niche-y, specialized, and focused that you can get with your major, that's where the jobs are at. There aren't a lot of companies out there saying, I have an entry-level managerial position. I'm looking for a college graduate straight out of school, and I want them to be able to do everything. You just came out of college. If you look at most job descriptions for entry-level managerial positions, they tend to be very focused, very niche, and very specialized. They expect you to have a bunch of strategic skill sets, but they expect you to work within this very specialized area. So if you look at the majors, degrees, and programs where demand exceeds supply, where salaries are through the roof, where students get multiple job offers when they graduate, it tends to be in those very niche, specialized areas. For example, there aren't a lot of companies out there saying, I'm looking for a general management major for this entry-level managerial position. This job right here tends to be a mid-level position or higher. You're not going to be interviewing for that kind of job. So one of the hottest degrees out there right now, and it's not going to change anytime soon because chances are the topic isn't going to become less important moving forward, is supply chain management. So instead of general management, we have employers telling us, I want your students to major in this, supply chain management, and then within that, I want a bunch of strategic skill sets. The end result is demand exceeds supply, and the starting salaries are in the 50s and 60s. Let me draw a little bit of a picture here. Let's say you work for a company, or you have your own company, okay? And you sell something for $1, or they sell something for $1, okay? After you sell something for $1, a product or a service, and you pay for all of your bills. So you sold it for $1 because that's really what the market will allow for in terms of what people are willing to pay you. You sell something for $1, you pay for all of your bills. How much would you like to have left over when it's all said and done? Here's reality. There are a bunch of companies out there that sell something for $1. This is how much they have left over after they pay for all their bills. If you look at companies that are in saturated, super competitive industries, that's what they have left over when it's all said and done. So now you're thinking, why the heck would you be in that business? Well, a company like General Motors, yeah, they'll sell something for $1. They might have 1, 2, 3 cents left over. But they do $150 billion a year in annual sales revenue. So when you look at the money that they have left over, they might have $10 billion in cash when it's all said and done after 1 year. So they can still make a lot of money, their margins aren't very good. However, that's unacceptable to any investor out there and anyone running a company. You can't sell something for $1, pay for all of your bills, and only have 1 penny left over. But in saturated competitive markets that are globally competitive, this is the nature of it. So my question is, let's say you're the CEO and you work for a company that sells something for $1 and you only have 1, 2, or 3 cents left over. What can you do to make more money? What we could do in this situation, would you guys agree that if you doubled sales, you can make more money? Like if I sell something for $1 and I got a penny left over, if I go into my company and we do something magical where we double sales, would you agree that that would help us make more money? But do you think that's what companies like John Deere, IBM, Boeing, General Motors, Chrysler are doing? Do you actually think they're sitting around saying, let's double sales revenue next year, let's double market share, let's double our volumes? They're sitting around saying, how can we prevent market share from shrinking versus necessarily increasing? So these companies are in a really bad situation because they have to make more money, but they can't make more money by selling more stuff because the market's so saturated and so competitive. So if you're in a situation where you can't increase sales revenue to make more money, but you have to make more money, how do you make more money?
Decrease costs.
Exactly. You cut costs. Okay? That's what these companies are obsessed with. They want to do things better, faster, and cheaper. Look at it this way. If you go into that company and you say, let's double sales revenue, it's going to be a pain in the butt. It's going to be a lot of work, and it's going to take forever, okay? And then when you do it, you're going to go to the CEO or your shareholders and say, I made us an extra penny. And the shareholders are going to go, yeah, that's great. That was a lot of work. We have an extra penny now. We're not that impressed. Also, I don't think a lot of companies in these industries that have these kind of thin margins can actually do that. So what they're obsessed with is cutting costs. Look at it this way. If you cut costs for your employer by $1, you go into your boss's office and you say, I've cut our costs by $1, that's the same thing as you going into your boss's office and saying, I'm going to give our company $1 worth of pre-tax profit. It's that simple. A cost savings, a $1 cost savings is equivalent to $1 worth of pre-tax profit. It's incredibly, incredibly effective, especially if you have a lot of slop and waste and opportunities for doing things better, faster, and cheaper. Everyone out there can do things better, faster, and cheaper. Even the ones that are really good at doing things better, faster, and cheaper, they can do it better, faster, and cheaper. Let's look at it another way. Let's say you sell something for $1 and you got 20, 30, 40 cents left over. Those companies in general have a reputation for wanting to increase sales revenue, market share, and volume because there's probably growth in the industry if they can price their products in a way that allows them to get away with those margins. So let's take a look at companies with really good margins. How about Stryker Corporations? Stryker's just like any other company. They want to make more money, and they have to figure out how do we make more money. The companies over here that only have 1, 2, 3 cents left over, the only way they're going to make more money is if they cut costs. The companies over here are probably in growth industries where the way they make more money is increase sales revenue, market share, and volume. And Stryker's no exception. They're obsessed with their sales workforce, and they invest heavily in their sales workforce because they think there's room to increase sales revenue to make more money. But they're greedy too, so if they can increase sales revenue, they also try to cut costs. So what's supply chain management? Okay. These companies that sell something for $1, when they pay for all of their bills, they have to look at where most of our costs coming from, okay? Probably 50 to 70 to 80 cents of that dollar is in direct material purchases. If you don't measure your costs and you don't know where your costs are coming from in excruciating detail, you probably have no idea how to cut costs, and you're probably not very cost competitive. If you look at the companies that are really good at this, they're obsessed with it, and they measure it in excruciating detail. And I just told you 50 to 80 cents or percent is in direct material purchases. Who are these purchases from? Who are you paying? Suppliers. It's supply chain management. So what's happened is a company like General Motors says, I do $150 billion a year in business in annual sales revenue. You add up all their cars and trucks and what people pay for them, it's about $150 billion a year in business. Supply chain management controls $100 billion of that. If you look at an automotive supplier like Delphi that does $15 billion a year in annual sales revenue, supply chain management controls 10 of that $15 billion. You look at most manufacturing companies out there, 50 to 80% of their spend, their cost, is in direct material purchases. So the greatest opportunity for most of these cost savings that I'm talking about is in supply chain management because that's where most of the costs for a manufacturing company are coming from. My student will get a job as a buyer buying $30 million worth of parts. That person's boss will say, you know, we spent $30 million on those parts last year. Could we get the same parts for maybe $27 million? And then you save forward $3 million. I think it'd be really cool if you had a job where you could say, boss, I saved the company $3 million in costs. Your boss says, okay, that's the same thing as $3 million worth of pre-tax profit. Is it easy to ask for a raise when you're saving a company $3 million a year and the savings keeps going year after year? By the time you get done with the curriculum, you learn how to do things where you can take $30 million and spend and reduce it to $27 million and justify your existence, which is worth a lot more than $64K a year if you can do that routinely on behalf of an employer. Do companies in the service sector that don't build anything want to do things better, faster, and cheaper? Do they want to cut costs? Do they not want to pay top dollar for stuff? Michigan State has a supply chain management program that probably has close to 1,000 students. The biggest recruiter of their supply chain program is the largest bank in the world, Bank of America. And at first I thought, well, why would Bank of America need people majoring in better, faster, and cheaper? Would you guys agree that Bank of America spends a lot of money, like on IT? Probably billions annually, and they're probably sick of paying top dollar. If they cut costs by a dollar, that's the same thing as giving them $1 worth of pre-tax profit, just like it is for General Motors. I've got a couple of students at Bank of America. Their first jobs at Bank of America were spending over $100 million a year in IT for Bank of America. You're 24 years old, you're responsible for a business of $100 million in spend, and you cut it by 15% over a 2-year time period. You're extremely marketable to a lot of employers out there. So we're noticing that most of our students, yes, they go work for manufacturing companies because they have the most skin in the game because their margins are the thinnest. We have a lot of students that are working for companies in the service sector because everyone out there wants to do things better, faster, and cheaper. And that's what our supply chain management program basically is we teach our students to look at everything as a process and look at it in a way where you can figure out how to do it better, faster, and cheaper. So we spend a lot of time working on problem solving. We have projects with local companies where we walk into a company and the company says, here's our problem, could your students look at it and tell us how to do it better, faster, and cheaper? Let's look at it another way. One of the most popular, important bottom line financial indicators for companies is this calculation called return on investment. If you look at this calculation, ROI, it's pretty simple. It's profit margin times asset turnover rate. So I just want to spend a little bit of time backtracking, and maybe you can figure out, based on what you're majoring in, where do you deliver an impact on this calculation? If you look at the calculation for profit margin, and your boss is telling you, you got to help me widen our margins, because there's the CEO putting pressure from the top down saying, help us widen our margins. You can make the argument that if you cut costs anywhere, you're going to widen margins. The problem is most companies out there, most of their costs are not in direct labor. The people that actually build the computers and the planes and the cars and trucks, that's a small percentage of their cost structure. Today, companies are so lean and mean, most of their costs aren't in overhead. It's in direct material purchases. That's why companies like Ford are obsessed with supply chain management students. From a marketing standpoint, how else could you widen margins? You could increase sales on stuff that has really good margins, but I think in saturated, competitive industries that are a global bloodbath, it's just not an option. You can widen margins or increase asset turnover rate. So what's asset turnover rate? Well, you take your sales revenue for a year, divide it by your total assets. What are your total assets? It's your current assets plus your fixed assets. What are your fixed assets? Stuff that I bought that's worth something, like a factory, land. And what are my current assets? How much inventory do you have on hand? What's it worth? Because you paid for it. Accounts receivable, help me here. This means the customer wrote the check and it's in the mail, but legally you can say it's cash in hand from your accounting class. Does that sound about right? And then also you have cash on hand. So my question is, this is all about how do we make ROI go up? We widen margins by cutting costs. Based on that calculation, what are some of the things that you could do to increase a company's asset turnover rate? Do more with less. I'll give you an example. 40 years ago, if you built a car factory, it would cost you $1 billion. It would employ like 3,000 people. Today, if you build a car factory, you can do it for $300 million, and it won't employ more than 1,000 people. And that new factory today will crank out 6 times the volume that a factory did 40, 50 years ago. That's doing more with less. Who's doing more with less? Who has higher asset turnover rate? Who has wider margins? Who can more competitively price their products so their ROI goes up, their stock goes up, their sales and revenue goes up? How about inventory? If you don't have any inventory, your asset turnover rate goes up. A huge push in supply chain management is no inventory. If we need stuff to build stuff, you get it to our factories just as we need it. We don't want it sitting around. You guys have heard of Apple. When they sell something for $1, they probably have 80, 90 cents left over. They're obsessed with supply chain management. Good for them. They're prospering and flourishing because of that. If I could leave you with an impression is you're all going to work for probably a company that's obsessed with this calculation, and you have to decide what contribution do I make to that calculation, and if you make a significant one, you've got nothing to worry about. My students in the supply chain program, most of them start off between 50 and 65K a year. By the time they're 30 or 35, they're usually responsible for between 100 and 200 million in spend. When you spend that much money on behalf of your employer, if you're really good at your job, you can generate huge cost savings, which means, okay, they're not going to pay you millions, but if you can save them millions, shouldn't they be paying you like 6 digits? So a lot of my students, they're called commodity managers, and they basically manage lots of different parts with lots of different suppliers, and most of them are in their 30s, and most of them base pay are between 100 and 150K a year, and they make anywhere from 20 to 50K a year in bonuses. It's easy when someone gives you $200 million in spend and you save them millions annually to walk into your boss's office and say, I'm worth 135K a year. And that's not a bad thing if you're 32, 33 years old.